Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started.
Trader Stacey Burke from Stacey Burke Trading, and we're just going to review easy, repeatable, best trade setups. We're going to be talking about this in the webinar tomorrow, the best playbook trade setups. And the whole 3-day approach that I talk about in the playbook is designed about coming to the screen and being able to reproduce in live time the interpretation each day of how I can look for a best trade setup. So the easiest method that I have focused on is the 3-day setups. And we talked about identifying the peak formation high or low for the week, whether that's at the end of the previous week or heading into a new week. And we'll just review, we're in the Christmas break, we're in between Christmas and New Year's, the beginning of a new month, about to start, the end of a month currently happening, and heading into a new year. And we talked about the opening range and the initial balance, not only of the week, the sessions, but the new year. So looking at today, after coming back after the holiday, we spoke about this last week. Around holiday time, people say, "Oh, I don't trade," but there are still tremendous opportunities because the markets still move. There might be thinner volume, but the same behaviors will exist. And an excellent question from a trader regarding a day such as last Thursday, where we have a market that false breaks the low of Wednesday, which was an inside day, and then breaks out on the upside, this Canadian dollar 15-minute chart, and fails to hold the breakout on the upside. So now we have a market that's peak formation low, peak formation high, false breaks on both sides. Which one do you use? Well, my response to that, number one, was the most recent one is always the one that takes precedent to begin the new count. The last peak formation that failed to begin at the high of the week begins the new count. So heading into Friday, we have a narrow range day. This did break Thursday's low, but for all intensive purposes, this is a day 2 inside bar or narrow range day after a failed breakout. We've talked about the 3 peaks or the 3 levels of rise. This blue line is 75 pips from the low of the previous day, our 3 levels of rise with a vertical peak formation stop hunt, and that is the pattern. At the timing window in the US window, they go up 3 levels. For the high of day sell on day 2 after the failed breakout, and you'll notice we talked about this last week, we noticed that stop hunt was up into the previous days, the previous Wednesday, the inside bar day, the high of the day. And then today, following on that, if that's day 2, we would either potentially be looking for maybe a reversal short squeeze, but we don't get that. We get a market that continues to break lower. We get breakout traders in the market, day 1 breakouts, and the market continues to auction lower. Now this one bull candle, we'll zoom in on this, I mentioned, when we have a low of the day, I measure up 25 to 50 pips and let price tell me where it's going to potentially reverse. So in this particular day, we had 3 levels of rise. Most stop hunts on average are 25 to 50 pips. This market moves up 25 pips, doesn't quite get there before engulfing into the beginning of our 12 candle window, second 15-minute bar. Now, you'll notice also we talk about in the playbook high bull major resistance, low bear major support. So marking off this level, and then the low of the day plus 25 to 50 pips. The market turns at the 25, not quite getting to 25 in the US window for the low-hanging fruit continuation trade. So just coming back to false break above the high of the week, day 1, day 2, day 3 for an easy, low-stress, low-hanging fruit trend trade continuation in the U.S. session. That market, although it broke down and pulled back, continued for a 50-pip trade. If we look at the Swiss franc, again, we go back and just look at our previous week. We have a low of the week that broke and that gave a short squeeze, parabolic short squeeze on Thursday at the low of the week. That's our day 1. That's our low of the week false break reversal. Heading into the new week, that's our day 1. Day 2, on Friday, the buy low day, that's our first green day on the Thursday. So again, first green day is a low of the day buy setup. Now, when we don't get that, we're going to look at some examples today. But first, green day is a low of the day buy setup. And you'll notice that the low of the day buy setup at the US 12 candle window after the news was into the breakout high level. So the first thing they do is they trigger breakouts on the upside. They don't break out, they just trigger breakouts on the upside. They come down into the breakout traders from Thursday's long trade on our day 2 and continue in the long direction, closing up high outside of the breakout. Today opens on a gap and auctions back down and gives a sell high setup in the London session open. So they break down and lower highs, lower lows. Coming back to, we measure from the low of the day. And 25 pips from the low of the day brings us right back up to where that market made the lower high for a London session high of day, high of session short trade into our high bull major resistance level. So you'll notice how accurate that is. There's no coincidence there. That's part of the grand organized design. There's a gap, it breaks down, makes a lower peak formation high, lower low, lower high, vertical, and I talked about this in the last video. This pump up is the trade setup. That's the trade setup from the low of the day, measuring up and then waiting for price to confirm your thesis for a London high of day short trade. They break through the low of Friday. Lower low, lower highs, we measure up again for our potential low-hanging fruit trade in the U.S. session. We have a lower high bull major resistance from the London session. The market does the same thing, proceeds to auction back up. 46 pips up into our short trades from the London session in our US 12 candle window at the New York Open for a 25 plus pip stop hunt back into the low of the day for a low-hanging fruit short trade. Looking at the Japanese yen, we had the huge move down last week, and then we had the inside bar day on Wednesday. Inside bar day, a narrow range day that sort of triggered the breakouts but didn't break out itself on the Thursday. So a double inside bar after a large move. That's a major potential reversal signal, a double inside bar. We also talked about that in the playbook. Then we get a breakout of the double inside bar on the Friday, a breakout that does not fail. And we are still on the front side of that move. Not suggesting that any of these are best trade setups, just going through the process and going back to what did yesterday tell us about today's opportunities. Hindsight pays. First green day, then we had the double inside bar and the breakout. That breakout has held. We are still on the front side of that move. So if you're trading that pair, you want to be staying on side of what is now currently a channeling market. Not to say that that's a best trade setup opportunity, but that's where the process could keep you out of potentially counter-trending a market that is not yet broken down. British pound, the market broke down quite strongly last week. We had a breakout of Wednesday's low on Thursday, but we closed back below that breakout level on Friday night. We also had an inside bar on day 2. Friday was an inside day. We had a pump up, peak formation, and a breakdown on Thursday. We didn't have a breakout of a weekly high or low, but we had a market that broke the high of the day, and then failed and reversed for a reversal day on Thursday. Friday was an inside day. So in the playbook, we talk about the two types of opportunities that can exist on an inside day. We had a market that went vertical from Friday night on the last leg of the move, but it broke down after 3 pushes up into the high of the day. So coming to the screen for the US session for myself, this is my interpretation of what's happened. If you're trading this during the day, we have a high bull major resistance level that fails. The market goes up and puts a high in place. We've climbed 3 levels of rise from the low on Friday night's US session. That's where the pump up began. The shorter blue line with the dots is 75 pips from the low of the US session, 3 levels of rise. We have 1 push, 2 pushes, a breakout that fails in the London Open for a short trade back down. We've triggered breakouts. We've triggered breakouts at the high of the inside bars. Breakout traders are triggered in the market on a reversal opportunity, and where is the money? So if a trader comes along in the U.S. session and the opportunity is already well underway, again, I don't want to be shorting it down low in the U.S. window after it's taken out the low of the day. And I'm not looking for a short squeeze. This is an example of what one trader pointed out. How do you determine which failed breakout is your day one? Well, at this current juncture, this is just in line with our original thesis. We have a day 3 high of day sell opportunity in a broken down market. So currently we don't have a low of the week taken out to put in a new peak formation. So this still remains to be a downward moving market. But again, London breakout traders triggered on the inside bar trade, the inside day trade, for a move back down, low stress, very profitable trade opportunity of 75 plus pips. The euro, very similar. We had our peak formation, low false break reversal on Thursday, inside day on Friday. They broke the high of the week, one push, so we redraw our levels. They went higher, we redraw our high of the day. And in London, they gave the engulfment in the gap time on the third push at the high of the week for a day 3 high of the day short trade, taking out not only the low of the day, but filling in the gap on the open of the day. So breakout triggers were triggered in long right off the bat, and we talked about this as well. Breakout traders are in the money and have not been stopped out. There's a gap there, and they come right back through that. There's a reversal, low of the day reversal at the New York Open, back up into shorts that were in at the high of the day, but a day 3 high of day sell opportunity, high of week, high of day on day 3. No low-hanging fruit. The market had already taken out the low of the day and filled in the gap. So if you're selling down low, you're selling right into the low of the day and the week, and they come right back up for a 50 pip stop hunt in the New York Open. Inside bar, high of the week, high of the day, London session short trade. So we had a peak formation on the S&P on Thursday that took out the low of the week, and inside bar on Friday that closed above the open and above the breakout, so that forms our peak formation day 1. First green day is a buy low opportunity, buy low of the day opportunity. It did not do that. It went up and worked the high and got breakout traders from Thursday's short trade in the New York session. It works the high, works the high, works the high. This pin hammer stop hunt is our pump and dump that breaks. That's our break-in structure on the inside. And then the New York continuation, the U.S. session continuation, and the blow-off move on the New York Open and the reversal. So short traders up top early in the picture. I don't look at the indexes until 9:30 New York time, and this is not one of my best trade setups to be buying into a broken down market. That can become order flow later for a continuation move back through the low of the day. So traders that are going long into this broken down market this market could roll over at the end of the session and take out the low of the day. Could be going lower, I have no idea, but first green day would be a buy low opportunity, low of the day opportunity, like we saw in gold, and we'll talk about that in a second. But this market went up. Day 3 worked the high in 3 pushes, breaking structure, rolled over into the US 12 candle window for a collapse into the New York Open. Now, I took a short trade on oil today, and I'll talk about that. As I mentioned to one trader, if we go back and look at the beginning of the week, we had our opening range Monday, Tuesday. Monday's opening range and our initial balance for oil. That market gave us a day 3 trend trade coming out of a failed breakout from the previous Friday. So again, that breakout failed. They came back inside of Thursday's low, and then consolidated in our opening range and initial balance for a trend trade on day 3 that continued to go higher. We had day 1 breakout traders in the market on Wednesday. Day 2 breakout traders in on Thursday that pulled back inside. So heading into today, this breakout that initially had failed continued back up. And to me, that's a reset. So we have a breakout level that's failed, and then they've continued to go higher on a day 4. That peak formation now becomes my reset for my day 1. This was not quite an inside bar, but a narrow range bar for day 2. Breakout traders again triggered. And then today we broke out right immediately on the open of Asia on what I called my day 3, a peak formation high. Peak formation high at the time of me looking at this in the U.S. session. The market made lower low, lower high, and broke down. This is my measuring point for the low of the day for my 3 levels of rise back up into the high. I had 3 levels of rise, and this is roughly 150 pips, but my thesis was that this market potentially may at least retest the breakout traders from Friday night's U.S. session that resumed the upward move. And so when this rolled over and broke down heading into the end of the hour, this is our gap time. When this broke down heading into the end of our hour, as this was engulfing, I'll zoom in on this. So again, my thesis was 3 levels of rise. We're in a market that's already broken down from the high of the week. On day 3, my thesis was that this market would at least blow through the low on the engulfment. So I entered into this market on the 1 minute with the 5 minute at double zeros, thesis being at least a 75 pip profit potential. When it broke through the low of this candle, my thesis was that this could still, because of the timings, we're heading into the second hour, we could still see a little pop-up, but then a collapse. Once it broke down, I followed this down as tight as I could, and immediately it reversed and took me out with a 30 pip profit target. Once it breaks through this level, the thesis for me on these trade setups is that it should collapse right through the low. And so I have no hesitation once it goes through the swing low and breaks down to lowering my stop loss so that at least if it reverses, it takes me out with something in the market. And this market did continue to break down and auction back up higher. And no problem. That's just trading. Key thing is taking the setup that I had, taking the entry, managing my risk, and then watching how price behaves. I don't care about being right or wrong or holding on to something. I've been burnt too many times. The whole thesis was day 1, day 2, day 3. I thought we would potentially get a stop hunt through this trap volume back into the breakout traders. Even if it pulled back, then it didn't matter. That's a first hour, 1 hour trade setup, done and dusted. It's, between Christmas and New Year's, you take what the market gives you. On to the next trade. The number one thing to focus on is just managing your expectations, managing your risk, and just being in the moment. A 30 pip profit is better than a 20 pip stop out, for a loss. It's not as good as 75, but it's okay. That's, the whole point is to be able to come to the screen, execute a best trade setup every single day. That's an easy, repeatable, simple strategy with very little stress, and then get on with your day. So we look at gold, we can see the high of the week from the previous week. We had the first red day, high day sell-off for a massive opportunity, which several traders nailed last week. That became our day 1. We had an inside day, and the reason that became our day 1 was that we had a large breakout, and we had an inside bar on Friday. So I restart the count on Friday. The market breaks the inside bar high and continues to auction higher. It goes up 100 pips, 3 levels of rise. Some traders shorted that trade back down into the breakout. Now, the key thing about when this downward move began was at 7 a.m. And you've heard me say that when a market moves before the 12 candle window, there's a high probability that that extreme will be retested. If it moves in the first hour, that may be the high or low of the session, depending on if there's major news and depending on if that's an instrument that trades in the New York session strongly. So, meaning the New York equity market open. So we have a day 1, a day 2 inside bar, a breakout, 3 levels of rise, and then the dump and pump setup for a vertical explosive move on day 3. Now that is a A lot of traders hesitated. They messaged me. They weren't sure if they should take that. I don't think you can ever predict an explosive move like that, but that's what happens. So on our 5-minute, we can see the pin hammer right at the New York Open for an explosive vertical explosion through the high of the week. And that's just trading. So sometimes, today I focused on oil. I was kind of humming and hawing looking at gold, and I liked oil. I thought it was going to collapse and just be done and have a short trade that moved 50 to 75 pips reasonably quick. It went 50 and then reversed. Whereas gold was obviously a fantastic opportunity. And that's just part of trading. You can't always juggle 2-3 trades if you want to be managing them with a decent, size on there. It doesn't have to be huge size or anything. It's holidays. But this is the type of explosive moves. But coming back to the process, the same principles apply. We had day one, we have an inside bar. They broke out of the inside bar. They pulled back into breakout traders right at the New York Open, first green day on Friday, for an explosion back through the high of the week. So these are easy, repeatable setups. And for me, this is a low stress, consistent, easy way to manage myself in live time, coming back to the screen each day and looking and saying, well, where am I at in the day count? What happened overnight? If you're trading in Asia, what happened in the U.S. session? Where's our day count at? Where's your bias? If I'm trading in London, am I at the high or low of the day? Is this a reversal opportunity? Is this a trend trade day? Is it day 2? How many levels of rise and fall? It's very simple once you get into the process and stick to, for me, the day count, peak formation highs and lows at the low and high of the week. We have an example here that broke out. It took out the low of the previous day. It didn't quite get to the low of the week, but you'll notice again if we come back from our original opening range and initial balance, when this market reversed on the inside day, it closed back on top. And we talked about the 3 things that markets do. They break out, they pull back, and they trend. They break out, they pull back, and they go into a trading range. Or they break out, they pull back, and they reverse. So sometimes you have to step back. And again, my focus is on these bigger opportunities. Gold has given some killer trades, and sometimes you don't expect that. But as Mark Douglas says, expect the unexpected. Anything is possible. So keep it simple, traders. We'll be dropping the link in the introduction part of the course, the playbook, best trade setups. I've had traders email me some excellent questions, and I really appreciate that. We'll be addressing those in the webinar. We'll be walking through the process, just refining. It's about simplicity, walking to the screen each day, keeping it simple, keeping it low stress, having asymmetrical risk reward with rinse and repeat, easily executable trade setups. Have a great day, traders. Happy holidays, and may the markets go with you.